What if everything you've been told about the biggest risks in the economy is wrong? Not AI, not politics, not the headlines screaming for your attention every day. What if the real risk is something so boring you've probably never even heard of it? Let me ask you something. Why are mortgage rates still high? Why do markets randomly panic out of nowhere? Why does it feel like money is still tight even when central banks talk about cutting rates? Because the answer isn't where most people are looking. It doesn't start in Washington. It doesn't start on Wall Street. It starts in Tokyo, and at the center of the story is one of the most overlooked assets in the world: Japanese government bonds. Sounds dull, right? Exactly. That's why it matters. Now let's rewind. Back in the early 1990s, Japan was unstoppable. Its real estate market was booming. Stocks were soaring. Confidence was sky high. And then, everything collapsed. The bubble burst. Property prices crashed. Equities fell apart. And Japan entered what we now call the lost decades. Not 1 decade, not 2, 3 decades of stagnation. No real growth, no meaningful inflation, no wage expansion. It was like the entire economy froze in time. So what do you do when your economy stops growing? You cut interest rates. Japan did that. Then they cut them again. Then they pushed them to zero. And when that still didn't work, they went negative. Yes, negative. And then they introduced something even more extreme: yield curve control. In simple terms, they decided to control long-term interest rates directly, no matter what the market wanted. They locked rates near zero. For decades. Now think about what that means. If you're a pension fund in Japan, an insurance company, a bank, and your safest assets pay you nothing, what do? You go somewhere else. That's exactly what Japan did. For years, Japanese investors poured money into the rest of the world. They bought US government bonds. They bought mortgage securities. They invested in stocks, real estate, and emerging markets. They became one of the largest providers of capital globally. But this wasn't random. It was pure math. Let's simplify it. Imagine an investor. He borrows money in Japan at almost 0%, then converts it into dollars, and invests in something yielding 4%. After costs, he keeps the difference. Simple. That's the yen carry trade. And it became one of the most powerful forces in global finance. Because when money is basically free, investors don't just play it safe. They take risk, they buy growth stocks, they chase higher returns, they push money into every corner of the market. If it offered yield, it got funded. At its peak, this trade wasn't small. It was massive. Trillions of dollars. It was like global markets were running on invisible fuel. And that fuel came from Japan. But here's the catch. This entire system depended on one assumption: that Japanese interest rates would stay near zero forever. And for decades, that assumption held. Until recently. In 2000, everything started to change. Japan ended its yield curve control policy, then raised interest rates for the first time in 17 years. And then they raised them again. Markets reacted immediately. Stocks dropped. Volatility spiked. Confidence shook. Because suddenly, the foundation shifted. Let's go back to our investor. Before, borrowing was almost free. Now it's getting more expensive. At the same time, protecting against currency risk costs more too. So that easy profit? It starts to disappear. The trade stops making sense. And when the math breaks, the money moves. For decades, capital flowed out of Japan. Now it's starting to flow back. This is called repatriation, and it's one of the most important shifts happening right now. Because when money goes home, it leaves a gap behind. And that gap matters. A lot. Japan wasn't just any investor. They were one of the most consistent buyers of US debt. And here's something most people don't realize. The Federal Reserve controls short-term interest rates, but long-term rates? They're driven by supply and demand. So if a major buyer steps back, yields rise. And when yields rise, everything changes. Borrowing becomes more expensive. Valuations come under pressure. Financial conditions tighten. Even if central banks cut rates, that's the part most people miss. Now think about stocks. How are they valued? Future earnings are discounted back to today using interest rates. So when long-term rates go up, those future earnings are worth less today, which means lower valuations, even if companies are doing fine. That's why markets can feel unstable, even without bad news. Now let's talk about housing. Mortgage rates aren't just controlled by central banks. They're heavily tied to long-term bond yields. So if those yields stay high, mortgage rates stay high. That's why housing affordability is still a problem. That's why refinancing is slow. That's why transactions are down. And it doesn't stop there. Think about businesses. A few years ago, money was cheap. Companies borrowed aggressively. Why not? Low rates made everything easier. Growth, hiring, expansion. But now, the environment has flipped. Higher borrowing costs mean less risk-taking, less investment, slower growth because credit is the lifeblood of the economy. And that lifeblood is tightening. So let's zoom out. For decades, the United States benefited from massive inflows of cheap capital, much of it driven by Japan. Now that flow is reversing. And the impact is everywhere. Stocks, housing, corporate credit, global liquidity. This isn't just one issue. It's everything. So why isn't anyone talking about it? Because it's not exciting? It doesn't go viral? It doesn't fit into a simple headline. People want easy stories. They want quick explanations. They want something they can react to instantly. But real financial risks? They're slow. They're complex. And they hide in plain sight. Here's the simplified story you hear everywhere. If rates go down, everything will be fine. But that's not always true, because central banks don't control everything. And if demand for long-term debt weakens, rates can stay high anyway. So here's the real question. What happens if buyers don't show up? What happens if one of the biggest sources of global liquidity steps back? Then the system has to adjust, yields rise, liquidity tightens, and the cost of money increases everywhere. That's when things start to break. Because the biggest risks aren't the loud ones, the ones no one is watching, the ones that slowly reshape the system from underneath. So next time markets move and it doesn't make sense, don't just look at the headlines. Look deeper. Because the real story might be unfolding somewhere you're not paying attention to. If you want to understand what's really driving markets, not just the noise, subscribe to Amy Invests and turn on notifications.